Trading psychology is a key component of why the NFT market exploded in such a way over the last year and a half. As of June 1st of 2022, OpenSea volume is at a staggering $37 billion, with 90% of that volume coming in the last 12 months alone. Those numbers are insane, and some people made a lot of money. But that's not the only thing that draws people into throw their life money and savings while feeling happy about it, at least while it works. We are going to go through a few of the key components that make NFT trading so addictive in the first place. Then we will go over how you can use those signals to your advantage. There are 5 things that make a good NFT buzz. The token effect, which is when you replace money with tokens, gambling your profits away as you don't truly value your gains due to the token effect. The social inclusion, which is a key factor in community building and online identity. The endowment effect, which is why people overvalue their own NFTs. And then the scarcity effect, which is when supply is lower than demand and drives floors to rise. The biggest reason why casinos use chips instead of cash is for the psychological aspect. It is much easier for players to part with a chip rather than a bill. The bill has more of an economic weight in the player's mind. They might already consider chips as paid for and therefore are much more willing to part with them as they've already counted the chips out. Playing with Ethereum or Solana has exactly the same effect on the mind of the user. This Bored Ape Yacht Club, for example, was sold for 1,024 ETH in May of 2022. At the time, it represented $1.2 million worth of Ethereum. It just doesn't feel the same to spend 1,000 ETH or $1.2 million, does it? It's called an abstraction layer between the physical asset and its true value. Losing chips or tokens does not hurt the same way. When an NFT trader overextends and spends a lot of ETH, we call it aping in the NFT world. And if you think about it, it's exactly like the casino. To enter the market, you need to exchange your currency for Ethereum instead of casino chips. When you make a great trade, you gain more chips, which still doesn't feel like real money. Therefore, you are more comfortable buying more NFTs rather than cashing out. Profits are gambling on the house money, which is the casino effect. When we trade dollars to Ethereum, we mostly see it as gone and don't often feel the urge to recoup the money because in theory, we played with money we could afford to lose in the first place. The profit effect compounds with this feeling as some traders will not cash out and keep playing with their gains. According to a study from investors.com, you don't need to hit home runs to win the investing game. Focus on getting base hits. To grow your portfolio substantially, take most gains in the 20 to 25% range. The best way to sell a stock is while it's on its way up, still advancing and looking strong to everyone. Now, while the study is related to the stock market, the same applies with NFT. Consistent small to medium gains are the best way to grow your portfolio. NFTs are more volatile than stocks and will sometimes skyrocket to multiple digit gains, but these are outliers. Slow and steady often wins the race. And always remember you're playing with money, not just a token. The problem with the casino effect is that it's just like a slot machine. You get minor payouts at a regular interval, which increases the motivation to place bigger bets, whether or not they are appropriate to the market condition in play at the time. This greedy behavior occasionally pays off with a big win, but mostly loses money over time, which opens the door to failure and a final exit from the trading game. To improve your chances of success, start your trading career by reading solid tutorials, materials on investing, trading, and the history of the NFT market. Many new traders will avoid the educational path because they are perfectly content chasing the illusion of easy money, looking for the market to provide the big paydays without working up a sweat. Logically, this works to the advantage of a more serious-minded participant like yourself, as you can take advantage of the weaker and less informed hands in the market. The best traders always remember to take profit, as a parabolic run of gains will never last forever. Cash out when it makes sense, and remember, if you make life-changing money, change your life. Social inclusion plays a big part in the NFT space, no doubt, but that's not it. You will see the best project heavily depending on their community to spread the message and onboard new members. PFP project worked so well for a long time because it creates a sense of togetherness on Twitter. You see someone with the same PFP collection and by default trust that person and like them a little bit more because you are already sharing something together. Collections that convince their users to change their PFP for their new NFTs are usually the one winning the long-term game. We can see on NFT Inspect that the top 5 most used PFPs are all collections currently doing very well. 52% of PFP per NFT are used on the Bored Ape Yacht Club. That's 5,200 Twitter PFPs with a Bored Ape, and there is only 6,400 unique wallets. That's basically everybody owning an ape using it as their Twitter PFP. That's an insanely high number of people willing to represent the Bored Ape Yacht Club brand by changing their PFP. And that usually speaks volume to those circle of friends and get them to wonder if they should ape in as well. Social inclusion is one of the biggest reasons why people don't sell their NFTs, even though they might be 10x on their investment. Leaving a social club that gives you a digital identity is extremely difficult sometimes. The endowment effect is the cognitive bias which results in people attributing higher value to goods merely because they own them. In other words, owning something increases an individual's perception of what it's worth. You can easily spot this trend in NFTs by looking at the listing price difference between a floor item and the most expensive listing. Bored Ape Yacht Club, at the time of recording, has a floor price of 84 Ethereum, but the most expensive listing is at 6,969 Ethereum, 82 times more than the floor price. There are certainly some joke listings way above anything logical, but these sellers show sign of endowment as they value their particular NFT much higher than the rest of the collection. Their token may be rare and have a higher value, but these price tags define most financial logic. When enough people feel the endowment effect, listings decrease and floor prices go up. The way you can identify this happening is only by scouting Twitter sentiment. If the project is trending on Twitter, it is likely to generate a pump in price as supply will see a short squeeze. Understanding when this happens can be a great indicator of price movement soon happening in a project. The scarcity effect is when rare things are valued higher than common ones. Everybody loves rare stuff, you included. We've seen plenty of research in the past that shows that people value something more simply because there is less of it available. Art auctions are a prime example of this, with pieces selling for millions of dollars. Scarcity is a major factor in the NFT space. NFTs in general are a part of history already, as it is the first time we have generative digital assets that can be created and listed to ensure ownership. Since every NFT is in theory unique, particularly with the PFP collections, as they have a unique combinations of traits that create a unique avatar. The rarer the avatar, the better. This chart represents the price per rarity score. You can see the price on the y-axis and the rarity rank on the x-axis. We can clearly see that there is a strong correlation with rare NFTs going for higher prices. But the price line flattens out very quickly at around the 1k or 10% rarity mark. Minting or revealing a rare NFT is something special. And although looking at the Bored Ape Yacht Club, it could be tempting to hold on to a rare NFT, most of the time it's actually worth selling this NFT, especially if you're going to make a 50 or 100x on your investment. Why? Well, most projects go to zero. Don't get blinded by the Bored Ape Yacht Club shine, and remember that the large majority of the projects will fail. Liquidity is low at these ranking levels. You can see just by looking at the frequency of sales versus listing for the top 100 rarest Bored Apes. There are fewer buys, meaning liquidity is rare to come by and you may not be able to sell your token easily. Most of the time, rare NFTs do not offer any extra benefits, but having multiple tokens can do. With that in mind, it could be worth selling your rare token to buy multiple cheaper ones to increase your exposure to the project if you believe in its long-term value. Buying a rare NFT is a delicate investment. It must be done with a mindset that the chances of never recouping your investment are extremely high. Let's take a look at another highly successful collection, Goblin Town. The highest sales for this collection range between 20 and 77 Ethereum. we can see the most expensive token sold for 70.75 Ethereum and is ranked number 6. The floor price is at 2.74 Ethereum. So what are the chances of recouping the investment and generate a significant profit? They are quite low. If you buy a rare token, you have to be prepared to lose more. Yes, it can be extremely rewarding with the Bored Ape Yacht Club, for example, if you bought early enough. Or it could be extremely costly if you bought a collection that lost traction like Mechaverse, where it is now virtually impossible to recoup your investment. This Mechaverse NFT was purchased for 125 Ethereum on December 26, but the floor at the time was only 0.74 Ethereum. Buying this NFT 168 times higher than the floor gives you very little chance to ever get that money back. And in this case, the buyer has never been able to sell the NFT, which has a 99% devaluation at current floor price.